Hey everyone, welcome to Next Chapter Financial Analysis. Today we're embarking on a crucial journey to understand the language of business, numbers. This video isn't just about data, it's about empowering you to make smarter financial choices. Before we begin, don't forget to like and subscribe. It really helps us reach more finance enthusiasts like you. Our core purpose today is to demystify financial statements. You'll gain a foundational understanding of why analyzing these documents is absolutely essential. We'll explore the four key financial statements every aspiring analyst must know. You'll learn what each statement reveals about a company's health and performance. Most importantly, we'll show you why you don't need to be an accountant to interpret these powerful insights. Let's dive in and transform how you view companies. Imagine meeting someone who claims, "I'm very successful, trust me." Would you believe them without any proof? Of course not. Financial statements are that undeniable proof of a company's performance. They are like a company's comprehensive report card, medical records, and bank statement, all rolled into one vital document. Without financial analysis, you're investing or evaluating blindly. With it, you're making informed strategic decisions. Here's a liberating truth many people overlook. You don't need a certified public accountant degree to analyze financial statements effectively. What you truly need is the ability to read these documents. You also need to interpret what they mean and apply common sense to spot potential red flags. Think of it like navigating with a map. You don't need to be a cartographer to follow directions and reach your destination. Similarly, you can master financial statement analysis with the right guidance. Every publicly traded company publishes four main financial statements. Understanding each one is key to grasping a company's full story. Let's explore what each of these fundamental documents tells you. The balance sheet shows a company's financial position at a very specific point in time. Think of it as a detailed photograph of the company on the last day of its financial year. It's a static picture of assets, liabilities, and equity. It clearly tells you what the company owns, assets, what it owes, liabilities, and what truly belongs to its shareholders, equity. The golden equation, assets is equal to liabilities, plus equity, always holds true. For example, if your house is worth 1 crore rupees and you have a 60 lakh rupees loan, your equity is 40 lakh rupees. The profit and loss (P&L) account, also known as the income statement, reveals a company's financial performance over a period, typically 1 year. Unlike the balance sheet's snapshot, the P&L is like a dynamic movie, showing all the financial events that unfolded throughout the year. It details the revenue earned from selling products or services. It also lists the expenses incurred to run the business. The simple formula, revenue minus expenses equal to profit, reveals the company's bottom line. This statement tracks how shareholders' equity changed during the year. Equity can increase from profits earned or new shares issued. Conversely, it can decrease due to dividends paid or share buybacks. Think of it like monitoring your personal bank account balance. Your starting balance plus deposits minus withdrawals equals your ending balance. This statement provides transparency into equity movements. This is arguably the most critical statement, showing where cash came from and where it went. This is super important because profit on paper does not always equal cash in the bank. A company can be profitable but still struggle with cash flow. The cash flow statement categorizes cash into three buckets: operating, investing, and financing activities. It provides a true picture of a company's liquidity and solvency. A company showing profit but negative operating cash flow is a significant red flag. Here's the beautiful part: these four statements are deeply interconnected, forming a cohesive narrative. Profit from the P&L flows into the balance sheet as retained earnings. The cash flow statement reconciles P&L profit with actual cash movements. Changes in equity directly link to the balance sheet's equity section. It's like fitting together puzzle pieces to construct a complete and accurate picture of a company's financial health. Understanding these links is crucial for comprehensive analysis. As an aspiring analyst, your approach should be holistic. Always read all four statements together, never in isolation. Look for consistency across these documents and be vigilant for red flags. such as growing debt despite reported profits. Compare current performance with previous years to identify trends. Also, benchmark the company against its competitors to gauge its relative strength. This comprehensive view will sharpen your analytical skills. Remember, financial statements are your powerful window into a company's true financial health. Master reading them, and you're well on your way to becoming a highly skilled analyst and a more informed decision maker. This knowledge empowers you. In our next video, we'll deep dive into the balance sheet, understanding assets, liabilities, and working capital in detail. If this overview was helpful, hit that like button and subscribe for the complete series. Let's continue this learning journey together.